Hey guys, how's it going? Option Sniper with the Santarelli Exchange. So, what we are doing right now is we are offering a free month to all new members. The promotional code is in the description section of this video. Our website link is also in the description section of this video. At our site, we offer a live chat during the trading day. We offer free weekly educational videos and live sessions, and we have a team of 3 professionals, and we're constantly analyzing the market for opportunities. And we are actually very excited about this week because of what happened on Friday. Friday there was a pretty big sell-off, and yeah, so we're excited about that. We'll get more into that. The promotional code for our site is Sniper. You enter that code, you'll get the first month free. All right, so today we're going to talk about what's going on in the market this upcoming week. There are some things happening in the market that are kind of important this week on the economic calendar, mainly being Wednesday, where the Fed, there's the FOMC minutes this week on Wednesday at 2 p.m. Eastern time, and the market is pricing in about a 90% chance that the Fed is going to raise rates on Wednesday. And basically what that does is that raises the short end of the curve, okay? Don't get this mixed up. I've typed this in chat a bunch of different times. Don't get it mixed up thinking that just because the Fed is raising the very short end of the curve, that the 10-year and the 30-year rates are also going to go higher. That's not necessarily the case. The Fed could raise the short end of the curve, and the longer end of the curve could still go lower. So, but what we did see on Friday is we saw a pretty big sell-off, and we saw the 10-year and 30-year both go higher. So that was pretty interesting. We'll look at that more here. But this is just the introduction. So glad to have you guys with us tonight. Hopefully, if we get more viewers at this time on Sunday, we will continue to do the session at this time instead of earlier in the day. So, all right. So let's get into it. Hope everybody enjoyed their weekend. This is pretty much it. And then, we're gonna be in chat tomorrow morning, but this is pretty much it for the weekend, right? It's just looking at the market now. I feel like this is a good time to look at the market because it's later in the day, so we're really preparing for the week to come now, and we're really preparing for tomorrow. So let's see. All right, so this is the economic calendar. I highlighted here, some more key things that are coming out, right? On Wednesday, June 14th, like I said, the FOMC meeting announcement is 2 p.m. Eastern. There's a high probability that the Fed is going to raise rates. And like I said, I posted this in the chat a couple different times. I'll post it again tomorrow morning. I'm in the chat every morning from 7:30 to 8:30 Eastern Standard Time. And so, yeah, I've posted this in the chat, like I said, a couple different times, where what the Fed is actually raising is only the IOER, okay? So don't get it mixed up thinking that just because they're raising rates on the short end, like I said, they're not going to raise, it doesn't necessarily mean that longer term rates are going to head higher. But what the IOER is it's the interbank overnight lending rate, okay? That's basically what it is. So what that means is when they raise that rate, it's going to go from it's currently at 1%. Basically what that is all banks, okay, I currently work at a bank in corporate finance. And so our bank, we get 1% right now on all of our cash. The Fed pays us 1% on our cash, okay? When they raise that rate, it's going to go up 25 basis points, so it's going to be 1.25%, and they're basically going to pay all banks 1.25% on all the cash that they have. Okay, so that's what that is. That's what the Fed is raising. They're raising the IOER. I'll post some more links on that in chat tomorrow. But that's the way it works. And like I said, there's about a 90% probability that that's going to happen, even though the economic data that's came out the last couple weeks was pretty weak. Specifically, non-farm payrolls, the first Friday of this month was a lot lower than expected. So But the Fed is still expected to raise, even though economic data has been definitely weakening. So CPI, Consumer Price Index, this is something that a lot of people pay attention to as well. We'll be looking at that. That's 8:30 a.m. Eastern on Wednesday. And another big thing that we're paying attention to every week here is rig counts. Okay, that's on Friday, June 16th. Rig counts, it's important because rig counts have continued to rise here for the past, I believe it's been 21 weeks straight now that rig counts have continued to rise. What does that mean? Well, what that means is when rig counts are going higher, that means more oil, all things being equal, more oil is being produced, right? So with more rig counts, it gives companies within the U.S. the ability to produce more oil. So the way commodities work is it's just all supply and demand, right? So all things being equal, assuming demand stays the same, with the rig counts going higher, supply is going to continue to increase. And with supply going higher and demand staying the same, that is going to have a negative impact on the price of oil. Okay, so now on Friday, oil was up a little bit, but we did see this week oil break the key 47 level and go lower. Okay, and at one point this week it was down 5%, over 5% one day. So that's one thing that we're continuing to watch here, because if oil goes low enough, if it goes down towards 40 again and it actually breaks that 40 level, that's really not a good sign. That's really not good for the market. Okay, last time oil broke 40 and went below that level, the market really didn't like that. Okay, the market's been stronger. Oil's been in this 47, 53 range now for a while, but it just broke 47. The weaker oil is, that's really not good for the market. Okay, generally what we've seen is the market has not liked the price of oil going lower. So that's why this is important. One of my favorite bearish ideas is still Hess. Okay, Hess was up a decent amount on Friday, but it did break that 46 level that I've been looking at in chat. I think Hess is still a decent portfolio hedge. Okay, so what I mean by that is if you get puts in Hess and if you're bullish the overall market, at least you'll have some type of hedge on your portfolio. But we're really, actually, after Friday, me at least, and the rest of us, I'm sure, after Friday's price action, short term at least, we're really not all that bullish. Okay, Friday, the S&P only closed down about 2 points, but FANG, which I'll tell you guys more about as we get into these charts, FANG was down huge. Okay, and FANG has been the main reason why the market is up in 2017. Okay, FANG, meaning if you guys aren't familiar with FANG, Facebook, Amazon, Netflix, Google. Okay, FANG, those four stocks have been a huge reason why the market has been higher in 2017. And those four stocks got absolutely slaughtered on Friday. Okay, and we'll look at that more here. But these are like the key things. This is Econo Day. I can show you guys the link to this. This is where everybody can get this information. It's free, and it's always very important to be aware of the upcoming key events in the market for the coming week, because these news announcements definitely have potential to move the market. And you know, every Sunday I like to go over this stuff. Last Sunday it was Comey. Well, what we saw last week was the market didn't really care about Comey, at least on the initial day. But then on Friday, we got you see this kind of a lot. It was surprising to some extent, but I call it a delayed reaction. Okay, and there may have been other things as well that kind of sparked that reaction, but huge sell-off on Friday. And, you know, the market when Comey was actually talking on Thursday didn't really seem to care. But sometimes, like I said, it takes a couple of days for the market to process the information. Okay, and what happened on Friday, maybe the market, you know, there's no real telling about why it happened, but basically what we saw is a lot of money came out of big tech on Friday. Okay, so this is the other thing. We've went over this a couple times, but I'm going to continue to talk about this. There's always trends to be aware of going into Expiration Friday, okay? Now, what is Expiration Friday? Expiration Friday is the third Friday of every month. This is when a large proportion of options are expiring. Okay, and we're heading into Expiration Friday this week. So that's another thing. Okay, Expiration Friday is a great week to head into. It's generally a more active week. Okay, things are more volatile, and this is because there's a lot more open interest on a bunch of options. All right. So what did I look at on Friday, last Friday on June 9th while the market was selling off? I pulled some data from SPY and IWM, the options chain, and what I saw was it was almost alarming to me with how many more calls than puts were open on the SPY. Okay, this was a huge. If you guys ever heard of put call ratio? Okay, put call ratio is how many puts are open for every call. It was absolutely skewed to the call side. Okay, now in here I have 4-1, but everyone looks at it kind of the reverse way. Put call ratio. Basically, there was one put open for every 4 calls, okay, which is insane. Okay, that's a very large skew to the call side. Basically meaning, like I just said, one put for every 4 calls was open. So what does that mean to me? Okay, I was looking at this close to the open on Friday when the market was still kind of strong. Close to the open on Friday, the IWM small caps were up like 1.5%. The market overall was up. Okay, like the S&P was up like 50 basis points. What does 50 basis points mean? That's 0.5%. Okay, 100 basis points is 1%. So the S&P was up about 50 basis points when I was looking at this. When I saw this, I didn't care that the market was up so much. Immediately, I thought to myself, wow, this is ridiculous. Next week, I think that there's going to be weakness. Why do I think that? Well, the reason why I think that is because there's so many more calls open than puts that there's a lot of motivation in the market to drive the market lower in an attempt to get those calls to expire worthless. Okay. Now, if you guys have been with the San Antonio Exchange for more than a couple weeks, you're probably aware of the fact that I look at this in heading into every Expiration Friday, and I think to myself, where does big money want the market to go in an attempt to get the most options possible to expire worthless? Okay, because a lot of the big money is shorting options. And so that's kind of an interesting thing to note to yourself. Why is big money shorting options? Big money is shorting options because the odds are stacked against a lot of options, right? So that's one of the reasons why I say it's so important to keep your delta at 50 or over, because it puts the odds more in your favor. But big money is shorting options that are out of the money, knowing that the odds are so skewed in their favor, okay? Now, a lot of these calls are obviously in the money, but if they are able to get the market to sell off, obviously these calls will be worth less. And whenever I see this, I've been watching this for a long time, okay? It just hasn't been the couple weeks, the last couple Expiration Fridays or the last couple weeks. It's been years. Every time I see where the big open interest is, it's a very, very, very high percentage of the time that the market goes down to where that open interest is, and also a very high percentage of the time the price action on the market goes to make that open interest, wherever it is, worthless, okay? So that's something to keep in mind. I'm going to show you guys the data that I pulled. We're going to look at a spreadsheet here. But yeah, okay, so let's see. Is there anything else on this before? Let's see here. Yeah, and we've talked about all this stuff, so I'll talk about the key range on the S&P. S&P futures is something that everybody should be paying attention to if you're not already. This is another thing that I've talked about a lot, but we'll look at that. But we're going to pull out and look at this spreadsheet that I've pulled with the data on the SPY and the IWM. I'm going to show you guys the open interest. We'll look at some of these things. Before we do that, I'll see if there's any questions. This is a live session, obviously, so we like to interact as much as possible and answer any questions and help anybody with anything that they have concerns about. So let's see if there's any questions. All right, so I don't see any questions, but I'm actually very, very happy to see that there's 24 people in here. Now there's 25. This is awesome. Last week, the past couple weeks, we've only had, 4 or 5 people, and that was at 12. We were doing a lot earlier, right? So it was at 12 p.m. Eastern, but seeing here that there's 25 people watching right now, that's awesome. I encourage you guys to ask questions. And John says, great observation on the market being driven in a direction to make the most options expire worthless. Question. All right, go ahead. Go ahead, John. What is your question? Happy to help. So Kevin says, with IWM making all-time highs on Friday, could we just be moving out of tech and into small caps and financials? So yeah, basically Kevin's asking if there's rotation. Now, there was some rotation, okay? Small caps were up, financials were up. Biotech was up a little bit too. We'll look here at the watch list as well that I like to post every day. Those things were up. Now, the IWM did not close at all-time highs. The IWM small caps actually sold off a lot, substantially, right? Small caps at the peak on Friday when the whole of the market was up, small caps were up like 1.5%. They only finished up 0.5%. So I'm not very confident that the market can be strong if FANG is going to be weak like this. Okay. FANG was so weak on Friday that I would be very surprised if there's not any follow through. You usually don't see a huge sell off like that and then no follow through to come. But we'll talk more here about kind of the playbook on Monday. On Monday, I'm expecting, at the open to be some kind of a bounce. And then I'm going to be looking to short that bounce, okay? Assuming that there's going to be more follow through to the downside in the market because Friday was a very big sell-off. It wasn't a very big sell-off in the overall market, right? The S&P was only down 2 points. But because it was such a large sell-off in big tech, in tech in general, I expect that there is going to be some weakness, some more weakness to follow, but we'll see here. Do I think FANG stocks will bounce next week? I think that with the open interest on the options like I was talking about, that at least in the beginning of the week, and this has also been a trend, right? This has been a trend in the market leading into Expiration Fridays for a while, where at the beginning of the week, the market's weaker, and then Thursday, Friday, the market rallies, okay? Now, that doesn't mean it's going to happen this week, and that doesn't mean it's going to happen every week, but it's a trend that I've been observing, but that's all driven by open interest, and this week's open interest is so skewed to the call side, with the VIX being so low, right? The VIX is below 10, that could be different this week. Okay, this is good. I like to see this interaction. This is good. Thank you guys for asking these questions. Okay, sometimes I have noticed that FOMC becomes a non-event. It's built up to be a huge market moving event. So yeah, I mean, John, most of the time the market is ready for what's going to happen leading into FOMC. Okay, it usually prices that in. So right now, the market is expecting, like I said, 90% probability that the Fed's going to raise rates leading into FOMC. So if the Fed does raise rates, do I expect the market to react large in any manner? No, because that's kind of already priced in. I would expect that to be priced in. So yeah, I mean, the market moving things, I think, are more when the FOMC is against the expectations. And a lot of the time it's not against expectations. on MSNBC, etc., but in fact it moves the market very little. Why perhaps do we think Wednesday's not so different? Well, John, I don't think necessarily that the market's going to move big on Wednesday. I'm just letting you guys know that how it works, and that there is a high probability that the Fed is going to raise again on Wednesday. That's kind of what we're talking about. I don't expect that really to move the market that much. I expect that to move, obviously, the front end of the curve, right? The IOER is what the Fed is raising. That's going to go from 1% to 1.25%. Now, how is that going to affect the 10-year and the 30-year? It could be either way, but Friday was surprising because we had a sell-off in big tech, but the 10-year was actually higher. Now, usually when you have a sell-off, you expect the 10-year to be lower, but there was actually, when rates go lower, that means bonds are being sold, right? So money was coming out of bonds and rotating into financials and biotech and small caps. Do I expect the bounce on Monday and then a sell-off or a turnaround Tuesday, or more than a one-day bounce? So with such a big sell-off in big tech, more specifically big tech on Friday, I expect there to be some kind of a bounce on Monday, and then I expect there to be more weakness after Monday. That's what I'm thinking is going to happen. Just because I'm thinking that's going to happen doesn't mean I'm going to be right, but I'm also going to implement a plan so that if I'm not right, I'm obviously not going to lose a lot. And I'll also be able to see if I'm not right and be able to reverse my position and ride the market higher if it decides to actually bounce like it did the last time we sold off when Comey talked. But the last time we sold off when Comey came out with that news, that was very unusual. Okay, you don't usually get a one-day sell-off and then that's it. When you get a big sell-off like we got on Friday, usually there's some kind of follow-through to come, okay, in price action. You don't usually see a big sell-off on one day and then the market just bounce and forget about it. That's not usually what happens. So Mark says it looks like we are rotating sectors. So yeah, I mean, like I said, we talked about this more last week, right? We did see some money come into small caps. We did see some money come into biotech. And we did see some money come into financials. But you can't ignore the fact of how weak big tech was, okay? Like, Netflix was down over 5%. Amazon and Google were down over 3%. Facebook was down, I think, over 3% too. And we'll look at that here on the watch list, but these big names were down a lot. Now, can the market in aggregate head higher with these big names being this weak? No, it can't. These big names are going to drag them. Just like these big names drag the market higher this whole year, they will also drag the market lower if they continue to sell off like they did on Friday. Okay, and the reason why this happened is because a lot of asset management firms, hedge funds, etc., that manage hundreds of millions of dollars and billions of dollars have piled their money into these names, and that's where they've got most of their gains for the year. And what we saw on Friday is a rush to the door with these names, with these bigger funds, right? So these bigger funds obviously were, for some reason, rushing to the door. And I think some of that had to do with Goldman Sachs. Goldman Sachs came out with a research report saying blah, blah, blah. Big tech's overweight. That's where the bulk of the gains have been this year and all that stuff. And so just like big money went into those names, we saw the beginning of big money coming out of those names on Friday, looking to lock in those gains that they've had in 2017. And if they continue to sell like they did on Friday, that should bring the market down no matter what happens, right? Like we saw, the S&P was down 2 points, even though financials and small caps were higher, and as well as biotech. So let's see. So Kevin asks, would financials continue after the interest rate announcement, or would it be maybe a sell the news play? So Kevin, the reason why financials were so much higher the last couple of days of last week, Thursday and Friday, was because the 10-year and 30-year, right, the long end of the curve, were higher. Okay, so it's really more dependent on that. And that's really like banks in general and in the financial sector, they're really very, very correlated to the 10-year, okay, the 10-year interest rate. And the Fed raising rates, the Fed has no impact on the 10-year. So yeah, I mean, it depends on what the 10-year does. And just because the Fed is raising rates on the IOER, which is the very short end of the curve, okay, it's the overnight interest rate that the Fed pays banks on their cash. Okay, it's nowhere near the 10-year interest rate. So just because the Fed is raising the IOER doesn't necessarily mean that the 10-year is going to continue higher. But if it does, if the 10-year continues higher, then that could potentially help the financial sector. Okay, that's why the financials were strong the last couple of days of last week, is really because of the 10-year and 30-year interest rates. And George says VIX almost hit 26-year low last week and bounced. Yeah, George, the VIX did hit, I think you're saying it almost hit a 26-year low. I know that it hit like a 15 or 16-year low, right? It was below 950, which is extremely, extremely low. Okay, extremely low. So yeah, the VIX did hit a low last week. Yeah, look at that, Kevin, and you'll see that they're likely gonna be very correlated. AIG and 10-year rates. Don't look at the 10-year bond, because if you look at the 10-year bond, they're going to be inversely correlated, right? Because as the price of bonds go down, interest rates go higher. So you want to look at the 10-year yield, not the 10-year bond, because the price of the bonds and the yield is inversely, right? So as money is coming out of the 10-year bond, right? As people are selling the 10-year treasuries, the interest rate on the 10-year treasuries are going higher. Okay, so you want to look at the chart of AIG and 10-year yield, not 10-year bonds. Okay, so I'm going to start talking about some more stuff here. But this is great. I'm glad to see that there's a lot of questions here. This is a lot more interaction than we've had here for a while. So I think Sunday nights are better than Sunday mornings. So we'll keep that in mind. And John, I will get to this question here after I talk about some more stuff. But don't worry. You type your questions in the chat. I'll make sure that I answer every single person's question before the session ends. So feel free to type them in there. But I'm going to talk about a couple more things here. Okay, so I was saying, like, I want to show you guys the options chain, right, that I was looking at on Friday morning. And actually, I'm going to start doing this every Friday morning leading into Expiration Friday. I'm going to start collecting data on this just because I feel confidently that there's a trend, but I don't have enough data collected to actually verify that, right? It's just something, it's an observation, but I don't have enough data to back that up. And I could go somewhere and pay to get that data, but I'd rather just collect it on my own, and then over time we'll be able to see that trend. So yeah, so let's look at this. Okay, so this is what I got off Bloomberg. Okay, like I said, I work in corporate finance at one of the biggest banks in the world, and I have access to Bloomberg. Bloomberg's like a terminal that you can get access to all types of data. Now, you could also get this data anywhere. It's not just on Bloomberg, but Bloomberg makes it a lot easier. And, you know, that's also where my watch list comes from, is Bloomberg. Bloomberg's like a very expensive thing. It's like over $20,000 a year, but big firms don't care to pay for it, that they have to pay for it because everyone has it, and they feel as though if everyone else has it, they need to have it as well. But anyways, if you look, this is what I see at the SPY, right? This is the call side. Okay, you see up here it's labeled calls. This is the put side. See up here it's labeled puts. What do I see here? So this is the SPY. Okay, what is the SPY? The SPY is the S&P 500 ETF, and this is where a massive amount of options are traded, especially heading into Expiration Friday. And June 16th is Expiration Friday. What is Expiration Friday? Expiration Friday is the third Friday of every month. It's where the bulk of the open interest is on every month. Okay, there's a lot more open interest on Expiration Friday than there is on any other Friday on any option chain, especially the ETFs. Now, what did I see here when I looked Friday morning? Like I said, I was looking at this Friday morning, probably like an hour after the open, when the SPY was still up strong. Everything was up strong. And I didn't care that everything was up strong, because after I saw this, I thought to myself, wow, there is 910,000 calls open, and there's only 227,000 puts open. And so I thought to myself, there's no way the market's going to go much higher than where it is from here, because there's just way too many calls open. Okay, there's way too many. There's just no way. There's no way that it's going to happen. And so what did I think to myself? Well, 245. Okay, this is the first closest strike on the SPY. And it was I think it was close or above to 245 when I was looking at this. And we can look here at stock charts at the SPY. Let's see. Yeah, so it was close to 240. It was probably a little bit below 245, because the high of the day on Friday was 245.01. So it was close to 245 when I was looking at this, probably a little bit below it. But you can see here, there's 151,000 calls open at the 245 level on the SPY. What does that say to me? That says to me that it's highly unlikely that the SPY is going to close above 245 on June 16th, because there's a lot of incentive to get all of these options to expire worthless. Okay? This is an observation that most people will never make in their lives, and that a lot of people, it's just something that most people won't notice. Okay? I go so deep into everything I do that I'm always thinking, I'm just always trying to think, right? So, but anyways, this is what I see, right? I see 151,000 calls open at the 245 level on the SPY. What does that tell me? That tells me that it's highly unlikely that the SPY is going to close above 245 on Expiration Friday, because there's a lot of incentive to get these calls to expire worthless, right? So, and then you look at the puts, there's only 18,000, there's only about 19,000 open on the puts, and there's 151,000 open on the calls. Okay? And then the next big strike is down here at 243. So there's even more motivation to get the SPY to come down to 243 or below, because you'll get all of these calls to expire worthless, right? If the SPY closes at or below 243 on Expiration Friday next week, all of these calls expire worthless. Okay? In my head, I think that there's incentive and motivation for that big money wants these calls to expire worthless. Now, this is just a theory that I have. It doesn't mean that I'm right. It doesn't mean that it's guaranteed. It doesn't mean anything, okay? It's just something that I think and that I've observed over the last couple of years, and it's usually been somewhat accurate, okay? But basically meaning, when I see all of these calls open, right? When I see a 4-to-1, okay? You see this percentage here? Basically what I'm doing is the put to call ratio. The put to call ratio is just the number of open puts divided by the number of open calls at all of these strikes. This isn't on all the strikes in the SPY, but this is on a bunch of strikes away from where the money is. Okay, so I think the SPY finished where at 243.50. So here's like at the money. You see here you have 6 to the downside and 8 right? So 15 strikes. The 15 closest strikes to being in the money, there is only one put open for every 4 calls. Okay, and what does that signal? That signals way too much optimism and extreme risk for a pullback. Okay, because like I said, in my opinion, there's a lot of incentive to get the large amount of open interests to expire worthless. Okay, because a lot of big money is shorting, hoping that or assuming that they can get these options to expire worthless, right? And they're collecting that premium as they short. So yeah, I mean, that's my idea. Like I said, I looked at that at the close to the open when the market was really strong. I just thought it's not likely that we're going to head much higher with all this open interest on the call side. Okay. And usually, like if you go back to the last expiration Friday that I talked about, usually it's not like this. Usually there's a lot more puts open. And when there's even if the put to call ratio is closer to like 50%, between like 50 and 75%, there's a lot more incentive to get the puts to expire worthless, because in general, puts are better to short because the implied volatility is higher. You get a better price. And so, yeah, but this is kind of a different week, right? This is a different week than what I'm used to. Usually I expect the market, usually the trend is the market heads higher in expiration Friday and they get a lot of the puts to expire worthless, but there's like no puts open on the SPY. So my observation was it could be different this week. And if you look at these columns, I just tell you, right, this is expiration date and strike price, bid ask, high, low. I think high low is a good thing to keep track of on options during the day, because when you're trading, you don't want to get filled close to the high, right? You want to get filled closer to the low. Volume, okay, open interest is extremely important. The more open interest you have on a strike, the better fill you're going to get, meaning you're going to get a better price because the bid ask should be tighter, okay? And the open interest change, meaning here, for example, 560 less calls were open, 25, almost 2,600 more calls will open at this strike. So this is just open interest change. And if there's big changes, it's something to keep in mind. Implied volatility, historical volatility, delta, theta. All right, that's what I have on my chain right here. Okay, and the IWM really wasn't as skewed, but the SPY matters a lot more. So the fact that the SPY was so skewed to the call side was definitely a red flag for me, to tell me that it's not very likely that we're going to, at least tells me that it's not very likely we're going to rally this coming week. Okay, that's what that tells me. Doesn't necessarily mean we're going to sell off like huge, but it tells me that it's going to be very hard for us to rally when you have all this open interest on the SPY, especially at 245, okay, and then 243. So we'll see how this week plays out, but this is something that I look at going into every expiration Friday. I'm always looking at the open interest, okay? Open interest on these index ETFs are very important to be aware of. And this right here, this percentage is open puts divided by open calls is extremely skewed, okay? Basically what that's saying is there's one put open for every call. So, or one put open for every 4 calls, right? That's what that's saying. That's extremely skewed to the call side, okay? Which is what makes me think that it's not very likely that we're going to be rallying this week. So yeah, let's see if there's any questions here. So yeah, Ragu, I think that a lot of the time when the Fed meets, the market likes what happens, and that can be the case. But because of what happened on Friday, that doesn't mean that's going to happen this week. Because nothing happens all the time, right? There can be times when things happen that don't usually happen. And that could be possible this week with the weakness we saw on Friday. So Kevin says the put side high open interest is at 240. The range could be below 243 but above 240. Yeah, I think that's a good, that's a good idea. That's definitely a good idea to have. But I think the key thing here to keep in mind is that what I'm saying is I don't necessarily think that the SPY is going to come all the way down to 2430, or this is SPX. This is kind of, if you add a 0 to the end of this, it's pretty close to what the SPX is. So SPX would be 2430, the SPY 243. So yeah, I mean, I definitely assume that the SPY is going to finish this week below 245. Okay, with that open interest, right? And at least finish at possible that it could finish at 243. Now maybe it just finishes at 244. But I think 245 is really the level that it's like, okay, it's likely that it's going to finish at or below here. Now, it may not get all the way down to 243. But I think the put open interest really matters a lot less than the call open interest. And yeah, I mean, the call open interest, the biggest open interest is here at 241. But when you look at it, there's still more calls open there, right? And when you look here at 242, at 243, there's just way more calls open. So, I mean, yeah, and even when you look at 242, it's like almost every strike, there's just way more calls open. So there's just more incentive to keep it at or above and not necessarily below. The put side doesn't really matter, right? Because even here at 241, there's still more calls open. So I always look at where is there more open interest on the strike. And if there's more open interest on the call side than the put side, then the call side matters more. If that makes sense. And usually it's not like this. Usually there's more. I'll see a strike and there's just way more puts open than there are calls. But that's not like that this week. There's just way more calls open on most strikes, right? So, meaning sentiment is when you see a put call ratio of 25%, meaning there's 4 more calls open for every 1 put, that just means sentiment is extremely bullish. And when sentiment is extremely bullish, there's extreme risk to the downside, right? Assuming that that's going to correct. It's just the way the market works. Usually most people are wrong. Okay, it's just the way it works. So you always have to be thinking about that. Like, which way are most people leaning? I want to go against the herd. Okay, that's the way I'm always thinking. Like, what way is the herd thinking? Okay, they're thinking this way. Like, what is all the reasons why I could go against them? And this week it's obvious that the herd is on the call side, right? Heading into this Expiration Friday. So. Okay, so I'll answer a couple of those questions later. This Friday is triple witching. What do you expect from this? So triple witching meaning there's options expiring on futures, and I don't expect that to change any of the way that I think about the market. And furthermore, options on futures is just insane if you think about that. It's a derivative on a derivative, right? That's what triple witching is. I don't expect that doesn't change my sentiment at all. And IWM, we're going to look at that here. So we're going to look at charts now. This is very important, guys, because Friday was a huge day, okay? Friday was the biggest sell-off in a lot of names that we've seen, I think, in almost a year, okay? Like, the market's been pretty quiet, just grinding higher. And when the market sells off like it did on Friday, we need to step back, take a look, and kind of reassess our sentiment on the market, right? So yeah, I mean, my game plan, like I said, with all this, after showing you guys this open interest on the SPY, my game plan is, if there's any type of strength on Monday, I'm looking to short that, okay? And this is the range I'm watching. In my opinion, everybody should be watching the E-mini S&P futures, 24.36, 24.17.75. So, yeah, I mean, Friday we had this big, massive candle on the E-mini S&P futures and also on the S&P 500. Pretty much similar. Similar price action, different price points. Okay? Now, my sentiment is bearish until the E-mini can get back above 24.36. Okay? This is the level I'm watching. 24.36 to the upside. If the E-mini, if futures get above there, then my sentiment shifts. I'm bearish right now. I'm assuming that there's going to be more weakness in the market with the huge sell-off we had in these big tech names on Friday. To the downside, 24.17.75. If the E-mini breaks that level, expect us to go a lot lower. Okay? So we're watching this range here on the E-mini, 24.17.75, 24.36. As a swing trader, swing trading options, I've said this a couple different times. I'll say it again. I'll continue to drive this home. 2-hour candlesticks are like the perfect time frame for a swing trader. Now, what do I have on this chart? This is from Thinkorswim. I have 180 days of 2-hour candles on the E-mini. I have the TTM squeeze and the ADX. Okay, ADX is a measure of volatility. The TTM squeeze is also somewhat of a measure of volatility. You see these bars getting bigger to the downside. That means there's likely that there can be more weakness. And when you see the green dots symbolize less volatility, meaning it's a better time to take a trade. And the red dots symbolize more volatility. Okay. Actually, I think I have that backwards. The green dots symbolize more volatility and the red dots symbolize less volatility. And this pink line symbolizes, it's just a volatility line. As this line goes up, volatility increases. As it goes down, volatility decreases. As option traders, we want to be buying options as volatility is decreasing. Okay? Now, this isn't necessarily a very bad time to still be entering options, considering volatility has been up here in the past. But it's really just price right now, okay? These are just indicators. Indicators to me are like training wheels. And indicators are very good for beginners, but price matters 1,000 times more than any indicator, because pretty much every indicator in the market is lagging price. Okay, it's a derivative of price. It's looking at what price has done in the past to compute what it shows you on these indicators. Okay, so the goal should be for every trader to get to a point where you don't need any indicators. You're just looking at price. And that's what I'm doing here. I have the TTM squeeze on here because it's a good measure of volatility. That's kind of like what matters the most as an option trader is volatility. And all that's great, but what matters the most to me is this range. After this huge move down on Friday, a massive move that we haven't had in months, like in a very long time, right? This range is what I'm watching. 24.36 to the upside, 24.17.75 to the downside. I don't even care about TTM squeeze right now. I don't care about any of these indicators, right? This is the PPS. PPS is also a pretty decent indicator. You see, you got a sell signal here with this down arrow. yellow cross below the blue. These indicators are invisible to me right now. Okay, now to someone that's newer, they can definitely be helpful. But with a big move like this is what matters. This candle right here. Okay, this candle right here. What did we do? At the close on Friday, we retraced about half of this candle. And that's great, but if we can't get back above 24.36, I'm going to expect a lot more weakness in the market, okay? And that's all driven off price. These things don't matter to me right now. What matters to me is price in this big candle right here. Where we're going to go, okay? This range. That's what matters. Okay, so I want to show you guys some bearish divergences here on the MACD and price. And as you can see, I drew some awesome lines here myself. You see how straight those things are, right? So yeah, I mean, in the MACD, I like to use 3-10-16. It's a lot more reactive, okay? But the reason why I like the MACD is because it helps me spot divergences, okay? Now, spotting a divergence is a lot more useful than anything else. A lot of people like to use the MACD to look for crosses, but really why the MACD is so helpful is because you can spot divergences. So what is this called right here? You see the MACD makes a high and then it makes a higher low. This is bearish, right? That's a bearish divergence on the MACD, but what is price doing? It's going to higher highs. Okay, this is a textbook bearish divergence. Okay, bearish divergence. And these are the weekly candles in the SPX on the S&P 500. So as confirmation, this week we would need to close below last week's low. What is last week's low? Last week's low is about 24.07, I believe. Let's take a look. Let's see what the SPX, the low of last week. Okay, I was a little off. 24.15. Okay, so we got this bearish divergence here. If we get a close below 24.15 this week on the SPX, that gives us confirmation that we can head lower. Okay, so very important is the highs and the lows of the previous week's candle always, as well as the previous day's candle. So 24.15, right, is the key level to the downside on the weekly candle. Okay, and the weekly candle is always important to look at first at the end of every week. So it's a great thing to look at on the weekend, right? And looking at the daily, if you look at the daily, it's the same idea. Closing below 24.15.70 as well on the daily, which is the low we made on Friday, would signal to us that we can head lower. Okay, and we also made a high of 24.46, right? Like I said, when I was looking at the open interest on these options, I think the S&P 500, this is the SPX, was well above 24.40. And I was still saying to myself, there's no way we're heading that much higher with all this call open interest and with this 1-to-4 put call ratio heading into the expiration Friday. I feel like there's almost no way that we can head much higher from here. And I wasn't expecting a huge sell-off like we got, but it's interesting that that's what happened. And this is just a very big candle, right? The wicks to the downside and upside, like Friday was a massive, massive day. And they were saying there was flash crashes on like Amazon and Google because they went so much lower and then rebounded. And we'll look at that more too. But yeah, you always want to look at the wicks. Okay, you always want to look at the highs and the lows of the previous day and the previous week, because if we get above or below those, it definitely is telling us that we can go lower or higher depending on if we go below it or above it. So yeah, that's S&P. Same idea here on the dailies, right? This is S&P on the dailies. Bearish divergence. You see the MACD didn't make, as S&P was going to higher highs, the MACD was not. Okay, the MACD was not going to higher highs. So this is also a bearish divergence on the daily and the weekly. Bearish divergences. And this was QQQ. Okay, QQQ is big tech. It's the NASDAQ 100. Okay, it's the NASDAQ 100 ETF. Big tech. Now, FANG makes up about 10% of the QQQ, which is a very big percentage. Okay, and this was actually a very, very bearish day for the QQQ because, and that was the weekly that I had up there first, because on the weekly time frame on the QQQ, we closed below the previous week's low, right? So the low of last week or 2 weeks ago, 140.57, we closed below that. Okay, when you, like I said, when you close below the previous week's low, that is very bearish. Okay, there is a high probability there that there will be more weakness when you close below the previous week's low, right? So yeah, and then the daily, right? I mean, I also have it in here, but it's harder to see the exact price levels. And you can see in here on the daily on the QQQ NASDAQ 100, there's also a bearish divergence. You see these awesome lines that I drew. They're very straight. Yeah, I mean, that's a huge candle down on the QQQ, right? The NASDAQ 100. Closed below the 17-day EMA and very close to the 50 SMA. So yeah, I mean, when you get a candle like this, right, the QQQ, the actual NASDAQ 100 ETF, was down 2.5% on Friday. And the QQQ is what has led the market higher here the past, most of 2017. This massive move down is definitely not good for the market. Okay, that's not good. The next thing I'm looking at here is the 50 SMA. I think that it's likely this week that QQQ is going to test the 50 SMA. Right? I mean, and you see what happens here. Like, this is a textbook, awesome example of, I've said this in the past, but I haven't said it in a while because the market has been chopping and then we just recently made another leg up. But I've said this in the past, and I've said this, but I haven't said it in a while, right? Is the absolute best the absolute best way to make money trading options is puts, okay? Why is that? Is because when you're buying puts, if the market is selling off, you're getting like a double bonus, okay? Because as the market is selling off, implied volatility is moving up, which is helping the price of your puts. And obviously also price is going lower. Now, even a third thing with that is that what happens usually in the market, okay, and a lot of people say this, is that the market takes the escalator higher and then it takes the elevator lower. Now look at this. May 18th, okay, we started this little upwards move in the QQQ on May 18th. We almost came and took out the whole move we had higher from May 18th to June 8th in one day, okay, in one day, right? I mean, look at how low we came, and we came down all the way to 138.11. We came from 144 to 138 in one day, okay? So this is just a great textbook example of how the most lucrative, best money to be made in the market is in puts. Now, obviously, you have to wait for the right setup and you have to wait till it happens, but look at this. Look at this move. You don't get moves like this to the upside, okay? Will you ever see the QQQ move up $6? Probably not, okay? But it's likely that you can see it move down like that. Why? Because the panic, okay? The panic. Like I said, these hedge funds and asset management firms managing hundreds of millions of dollars and billions of dollars, they all piled into big tech and QQQ to help their returns for 2017 and the QQQ rallied higher. And then they all freaked out and started selling on Friday at the same time. And look at what happens with panic. Okay, you get this big move down, which you just don't see to the upside, right? You just don't see that. And so it's just a great example of why it's holding puts is by and large the absolute best way to make money trading options. Okay. And when you get a move like this, it's very rare that you don't see more follow through. Now, when Comey came out with that news, I think that was May 31st. I believe it was May 31st when Comey came out with that news that blah, blah, blah. Trump was trying to interfere with whatever. Okay. The market sold off hard, but big tech QQQ didn't really sell off that much. Right? I mean, the market sold off a ton, but QQQ was kind of held up pretty well. That's not what happened on Friday. QQQ absolutely got obliterated. And usually, when you see the leader, okay, the QQQ has been the leader in the market for the past couple months. When you see the leader this week, that's usually a signal that the market's going to be weaker, right? If the QQQ led the market higher and now it just tanked, like the biggest it's tanked in like over a year, that's a pretty decent signal that there's going to be more weakness. Okay, you don't usually see a big move like this and then that's it. That's not usually what happens. Okay, now recently, I guess you could argue that it's been more prevalent, but when was the last time we got a 2.5% move in the QQQ to the downside? And then if you look at a 2.5% move or more to the downside, I mean, when did we not get follow through, right? I mean, I can't remember. Like, it's just when you get weakness like this, you just should assume that there's going to be follow through. You just have, and so if the QQQ is actually at any point on tomorrow morning, if the QQQ is at any point a little bit higher, that's just like, to me, that's like a layup to short that, right? I mean, I don't want to be shorting into the teeth of the sell-off, but I would love to be shorting big tech and QQQ if it's bouncing a little bit tomorrow, right? Just under the assumption that if we can't get back to the open of this candle at 143.73, that we're gonna head down back to this 50 SMA and at least test that. Okay, and we have gotten way, way above the 50 SMA. So yeah, I mean that's kind of the extent of the massive sell-off that we've had, and the QQQ has, like I said, has been the leader here the past all of 2017. Okay, I'm gonna look at this chat here. I like this all. This is great. Let's see. I feel that with the sell-off on Friday, Bank of America, Netflix, Amazon, Apple, and Netflix, Facebook are trading so south of their normal range. I feel like they will bounce back to normal, but we're feelings and emotions. Yeah, I mean, so like I said, FANG is gonna look almost exactly like QQQ, right? Like Netflix is one of my favorite vehicles to ride the market lower on, just because it's really just like a piece of doo-doo, right? I mean, Netflix does not make any money, okay? Netflix is, if you look at their income statement, if you look at their balance sheet, fundamentally, their EPS is still negative. EPS is earnings per share. They have negative net income. As a business, Netflix is still not making money. Okay? And look at this. I mean, look at this bearish divergence on Netflix. Like, sticks out to me like a sore thumb. So, this bearish divergence and then this confirmation candle, like, Netflix could easily this week be below its 50 SMA, in my opinion. Okay? Now, what am I looking at? What can you look at with big candles like this? What you can look at with big candles like this is the 50% mark, right? We made a video here about the Fibonacci retracement level. Okay, if it gets back above the 50% retracement level on this candle here that it made on Friday, which is just a ridiculous, massive, like, this is what I'm saying. When you see this is like panic, okay? Do you see this candle here? This is not normal. This is not like, you just can't, oh, yeah, I mean, so it's an okay argument that you're saying, okay, it's way out of its range that it's been in of whatever time frame. But this is not normal, okay? When was the last time Netflix was down almost 5%? And then when it was down this much, when was the last time there wasn't anything else to go with that? Like, it's just, when you see this, I assume in my mind, the way that I've been taught, the way that I've been trained, is to short any strength, okay? When you see a big down candle like this, the way that I've been trained is to short strength. If tomorrow Netflix is back up to like 160, I'm still looking to short that, okay? And what you can say on this candle here is the 50% retracement, right? So we can actually pull it up on Thinkorswim. I can show you guys here. We can look at Netflix. You see how I have futures here? So this is the other good thing about Monday night. We can see, S&P mini down 1 point, okay? Because futures are actually live right now. So okay, so what should we measure here? What I would be measuring here is, and it's just really like, for me, it would just be like a rough estimate, but I want to show you guys like the exact measurement and the way to do it. And so you can just go here and just look at the Fibonacci's. It's in drawings. Yeah, so I mean, you just look here, right? From the swing high to the swing low, okay? And if I want to get it exact, what's the high here? The high here is 166.27. The low here, 154.50. So 166.27 and 154.50. Okay, so immediately what price level do I get here? Is the 618 is 161.77. Okay? Meaning if Netflix closes above at any point this week above 161.77, that this downwards move is a lot more meaningless, okay? So this downwards move, if Netflix gets above pretty much 162, if Netflix can get above 162 and close above there, then this move is a lot more, this downwards move on Friday is a lot more meaningless, okay? But for me, if Netflix gets between 160 and 161, this is a prime place to be looking to short Netflix. And how do we short Netflix as options traders? Obviously, we're just buying puts, okay? And how am I buying puts? I'm always buying puts with at least a 50 delta. And if I'm buying puts with the 50 delta that expired on Friday, I'm not putting a lot of my account into that, right? Weeklies, you don't never want to put a lot of your account into weeklies. And I'm still never putting a lot of my account into anything that expires within less than 30 days. Okay? But really, this is kind of the line in the sand right here. The 618 retracement of 160, 177. Okay? And it's kind of tough to use this because this low here is like flash crash status. Right? Fang like had like a flash crash on Friday. So I almost feel like this low here is kind of like you can't even really use that because it's just so the algos and everything were just freaking out when it was selling off like this. And it just flash crashed all the way down to here and then warped up to here like so fast that this wick down here is kind of like I almost feel like it'd be better to use this level here. So and if you use that, it's going to change the levels. But I think it's probably better to use this low here instead of this wick. I think it's better to probably use this wick, which is 156.84. Because all of Fang literally flash crashed on Friday. And it has to do with algos, right? I mean, these big funds, a lot of these big funds that are managing hundreds of millions and billions of dollars, they're quant funds, meaning they have machines trading for them. And so if things happen, the machines just act. And weird things like this occur if big sell-offs happen. I mean, I don't think Netflix was down there for more than 2 minutes and then it bounced back up. So, I mean, if you take 156.84, which is the low of this candle, it changes things a lot more, right? 160, almost 163 is where you need to go to say, okay, this downwards move doesn't matter. I would say 162, if Netflix comes back above 162 and closes above 162, then the probabilities shift, right? But if we're between 161 and 162, I'm still gonna be looking to pick up some puts. And as traders, right, when we first enter a position, it's kind of like, in my opinion, you should always start small. It's kind of like you're dipping your toes in the water to assess the situation and see if it works. And if you're dipping your toes in the water and it doesn't work, you're not going to get hurt that much. And if you're dipping your toes in the water and it does work, then you can just add to it, right? So I would be looking on Netflix on tomorrow, this 161, 162 level, I'd be looking to pick up some puts, okay? And then if we actually can close above 160, above this level, 162.50, I would just say 162.50. If Netflix can close above 162.50 tomorrow in this week, then it's likely that we're just going to head higher, and the market's not really going to care about this massive sell-off that we had on Friday. And that's always a possibility, right? It's always a possibility with this market that we just snap back and it doesn't care about anything, right? It doesn't care about the bearish sell-off that we had. But the way that I've been trained, the way that I've been taught by experienced people, right? I do like a mentorship with someone that's been trading for over 30 years. He's an option trader. And, the way that I've been taught is with a huge sell-off like this, you should be hoping for a bounce. And if you get a bounce, you should be grateful for that bounce and you should be ready to short that bounce, okay? So, I mean, that's going to be my game plan going into tomorrow is looking to short either a stock like Netflix or Tesla. Both stocks don't make any money. Fundamentally, they're garbage, right? And the companies that are garbage fundamentally, those are the companies that get absolutely smashed when the market sells off, okay? So just keep that in mind. Like Netflix and Tesla are probably two of the best vehicles to ride the market lower when the market actually does sell off. Okay? So just keep that in mind as well. Let's see if there's any other questions. Yeah, Ragu. So Netflix, I'm sorry, not Netflix. S&P 500 did recover a lot more than the NASDAQ. Okay, but my thinking on this, I think I talked about this a little bit about the QQQ NASDAQ 100. My thinking on this always is that the sector that led the market higher, if it's now this week, I would expect it to lead the market lower as well. And that's just, I mean, if it led the market up, it should be, I would assume that it's going to lead the market down as well. Okay, so that's the way I think about that. With the leader being that week on Friday, I would assume that the market, there can be more weakness in the market heading into this week. Okay, and you see here, we're well over an hour 15, but that's fine. It's because you don't see price action like this normally, okay? This, like, Friday was such a significant move that we need to talk about this in detail, and we need to have a plan for tomorrow and heading into this week to attempt to capitalize if the market continues this weakness, okay? And the fundamental data as like economic data in the market has definitely been trending to the downside. It's been weaker, and that's also a backdrop on the market. But in my opinion, tomorrow we should be ready to establish a smaller position in puts in Netflix or Tesla if they are up at the open tomorrow, under the assumption that this initial move down wasn't all that there's going to be. Excuse me. Sorry, I had to grab some water. Throat's been really dry past couple weeks. So John says, get us in trading, give us some guidance on this line of thinking. So like I said, I'm going to be in the chat 7:30 to 8:30 Eastern every day this week. So I will be in there ready to help you guys with this guidance. My throat is so dry right now. I'm sorry, guys. I can't stop coughing. I just popped a cough drop in, some water. It's just super dry. So there's no... Sorry, guys. Ragu asks, how can we know this buy calls are bought or sold? There's no way to know. Open interest, you don't know if they're bought to open or sold to open. But with me, I always assume that the majority are sold to open. All right, guys, that's going to be it for tonight. My throat is just way too dry to keep talking. I feel like I have sandpaper in my throat right now. So if you guys have any other questions, I'll answer it in chat here for the next 30 minutes. And then I'll be in chat tomorrow, like I said, 7:30 to 8:30 Eastern. And guys, nobody is ever always right in the market. So just because this is my assessment and observation on the market doesn't mean that it's going to be right, okay? Nobody's always right. I could definitely, the market could just, like the last time it sold off big when Comey broke that news, the market could just rip higher again, just like it did last time. So yeah, but everybody have a good rest of your Sunday night.